Hey, fellow note investor. Are you looking to learn the basics of note investing so you can get started? However, you don't want to spend a few hundreds or thousands of dollars and hours online on some training program? Have you thought about attending a notes conference? However, you don't want to spend the money or the time away from your family. Well, we have a tremendous beginners video series of 20 different topics, with each video being less than 15 minutes. This means each video is less fluff and direct to the content. Visit www.jkpholdings.com/beginner-series to learn more. Again, www.jkpholdings.com/beginner-series.
Yeah, I'm not sure. There we go. Let's try it. Hey, everybody here. Dave Putz here from JKP Holdings. Alongside me, as always, Mr. Nathan Turner. How you doing, man?
Very good, very good. How are you?
Oh, good, man. The week goes fly by, past. Just all of a sudden, Friday comes up. I'm like, holy God!
I woke up this
been
morning
a quick
and went,
week.
wait, what day is it? Oh man, Friday already.
So it's funny. We get in this
Flies.
space. We're doing this stuff. Weeks go by fast, and Fridays are not the worst. The best day of the week. It doesn't matter. Like, you're just doing it, which is awesome. So
that one day, yeah, it really doesn't make a difference. The only way it makes a difference for me is, I think we talked about this once before, is that's how I organize what I'm doing each day. So my Fridays is kind of a filler day, and so that's how I kind of
that's crazy
plan my time.
So I know last week we talked about you buying some CFDs and whatnot. And made some more offers. We made a few offers. We got rejected, so we're going to move past them and move on. Yeah. What's up with you, man? What's going on?
Last week, I don't remember if last week I'd already closed or not. I don't remember, but anyway, I just picked up three more, all three mortgages. I had some offers out on some CFDs, but not looking good. So I don't know. We'll see. But it's fine. That's the nature of the business, and if it works, it works. If not, you move on to the next one and keep moving.
Yeah. And then all these moratoriums coming through, it doesn't really affect us right now, right? These struggles and stuff like that doesn't really affect us because of what type it is. So I know you're looking at some lease options as well, which is pretty cool. So
yeah, I'll buy anything in first position.
Oh, it's funny because we do all that stuff and we say all that stuff, but it's true, right? If that security's there is what we care about.
Yeah.
And we had a great session last week. The last couple weeks been awesome stuff, and we talked about seller financing. And I'd reached out to Dan. I've been watching him on Facebook a little bit, and I said, "Listen, he's doing everything everyone else is doing. What new could there be?"
Yeah.
And it seems like every time I say stuff like that, there's something new out there. And I'm like, and I shot a message to him, and he was grateful enough to entertain me for a few minutes. And I was like, "Whoa!" So I'm excited, right, to bring Dan on.
Business. There are so many different ways to do this, which is just great. The challenge with that is you pick one and then do it. Unless you're Ray, and then you do three different things.
Yeah. Oh, it's just frustrating, right? Because it's just there is no ultimate person in this space doing everything that he should do. Ray's close, but I think for me it's interesting. So well, I think I'd like to introduce Dan to our weekly Facebook Live. Dan, can you share a little bit about your background? How'd you get into real estate? What kind of stumble blocks you came across, and what are you doing now?
Sure. Well, first of all, it's an absolute pleasure and honor to be here. I'm excited. I know you're definitely very active in the note world and note creation and note buying and things of that nature. And when you reached out, I I was excited. So thank you for having me here for sure. A little bit about my background. My name is Dan Diaz. I was introduced into the wonderful world of real estate through what I like to call wheel estate. Wheel estate. So for about 4 years, I was manager for Palm Harbor Homes here in San Antonio, Texas, actually a little town outside San Antonio called Elmendorf, Texas. And as general manager for Palm Harbor Homes, I got a glimpse, a behind the scene glimpse to real estate. I was able to see a lot of aspects that I had never been exposed to before. And I fell in love with it. What I did not like was that I did not have an 8 to 5. I had a 5 to 8, and that was 7 days a week. And I hated it. Made really good money, but I hated it. So right around 2004, I really started educating myself. I started learning about owner financing. I started learning about landlording versus lien lording. And I could tell that my personality kind of veered towards owner financing, towards notes, towards lien lording. And I finally took the leap in November of 2015. First deal generated me over $80,000 in upfront profit and a $400 monthly spread for the next 30 years. And I was absolutely hooked.
Wow.
It took me a long time. It took me 9 months to realize that deal. And to me, it was the litmus test. If I could do this once, then in my mind, I could do it again and again and again and again. So if I was able to produce it once, then that was enough for me to quit my job. So that very day when we closed on that property, went ahead and submitted my 2 weeks notice. My boss obviously wasn't very happy because we were producing really, really well. But I knew 80 hours a week was not for me. So I started off like a lot of owner finance investors, buying the home, fixing it up or cleaning it up, and then selling it, carrying the note. As we started growing in 2016, I started noticing 2 problems. One, the problem was there was only so much inventory that I could handle. Maybe you can handle more, but there was only so much inventory I could handle. For us, it was about 3 to 5 homes at a time. So we needed to kind of sell one before we could get another one.
Yeah.
And through our marketing, we started coming in contact with these really, 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 really great buyers. I just didn't have the home they were looking for. Mm-hmm. So they had a great down payment. They had great ability to make payments. Maybe they didn't have a social. Maybe they were self-employed. Maybe they had bad credit, whatever. But they had a great down payment. They had a great ability to make payments. We just didn't have their home. They wanted something newer, bigger, 2 stories. They wanted a certain zip code. They wanted a certain, school district. Mm-hmm. And I started scratching my head and I'm like, how can we capture these buyers? Mm-hmm. And it was right around 2017, late 2017, early 2018, that a light bulb literally hit me. And I realized the problem is not inventory, Dave. There's 10,000 homes for sale on the MLS. So why am I focusing on trying to build up our inventory to bring to the market? Inventory did not seem to be the problem for us. The problem was finance, how to acquire the money. And of course, I started kind of researching, and there's not a whole lot of banks who will lend you to wrap their money. So that really wasn't an avenue. But then I was introduced to the wonderful world of self-directed IRAs. And I was introduced to, the nearly $13 trillion of money that's sloshing around in self-directed IRAs, people wanting stabilized, predictable returns. At least the people that we came in contact with, they didn't necessarily want a higher return. They were approaching the retirement years. They were between 45, 50, 55, maybe 60 years old. They wanted something stable. They had already built, $500,000 nest egg, $1 million nest egg, $2 million nest egg. Yep. But they just didn't want to go through a huge loss in the market. So they were looking for something a little bit more stabilized. So now what we do, about 70% of our business, is we start with the buyer first. We make a determination of their real world ability to repay based upon their initial investment and their income and their liabilities. Once we make a determination of their real world ability to repay, we go ahead and raise the necessary capital for them to purchase their homes with owner finance terms. I'm very proud of the notes that we built for them. 30-year mortgages, no balloons, no prepayment penalties, no mortgage insurance, obviously. We don't mark up the home either, which is important. There's a few other investors that have popped up in the industry, and what they'll do is they'll buy the home and then they'll mark it up 10, 15, 20, 30, I've seen even up to 50%. I guess there's nothing really wrong with that model, except that the buyer's upside down from day one. So refinancing is nearly impossible for at least 7, 8, 9, 10, 12 years. We don't mark up the home. We simply focus on the funding of the transaction for them. So that's the bulk of what we're doing. We're still a small family owned and operated business. We do about 4 or 5 deals a month in Texas. Our average deal is about $320,000. We'll do anything between 150 up to 1.2 million. And what's really nice is that we're now in the owner finance world, but we're in the pretty homes. These are beautiful homes, great neighborhoods. If we ever get them back, I mean, I'm going to be happy, to own them. These are beautiful homes and great neighborhoods. So that's kind of what we're doing now. And I guess it is a little bit different than most owner finance transactions.
Yeah.
That's really interesting. So you covered your price point. How did you get up to that? Like, I'm assuming you started out lower and went up higher. And if that's the case, why?
Not
Why not stay at a
necessarily.
lower? Yeah. Okay.
Yeah, not necessarily. So there's a lot of inventory. I'll use that term. There's quite a few owner finance, sellers and investors in the $100,000 to $200,000 range, and most of them are happy with 10% down. So if somebody is wanting that range, they're not going to like our 20% requirement, and there's quite a few out there that they can kind of go to. The reason a lot of owner finance investors stay in the $100,000 to $200,000 range is because they are trying to make the mortgage payment be equal to or similar to market rents at a 9, 10, 11% interest rate. And the math tells you that once you go over the 175, 185, 195, $200,000 range, if you're going to keep, your 9, 10, 11% interest rate, and it's going to be comparable to market rents, you're kind of going to be capped off. Now, our perspective is we're going to let you buy whatever home you can afford. We approach it more like a bank or a mortgage company. This is our interest rate. It's currently 9%. So you want the $300,000 home, knock yourself out. We don't care. You got 20% cash to close. We don't care. So our mortgage payments are nowhere near market rents. I mean, it's just the mortgage payment. It's just the cost of owning your home. So we approach it, from that kind of perspective, and we're very successful. I would say about 65% of our clients, even though they bring 20%, they really have 40 to 50% liquid cash. About 65, 70% are ITIN buyers. They don't have a social security number in this country, but they're affluent. They're already paying $3,000, $4,000, $5,000 in rent in the neighborhoods that they want to buy. So it isn't necessarily a sticker shock. The other advantage for us from a psychological perspective, and your audience may know this or they might not, but most of our buyers being from Mexico, Central America, and Latin America, in Latin American countries, interest rates right now is anywhere between 35 to 50% a year.
Holy smoke.
So when you're giving them 9% interest rate, they're happy. They're not going to say, they're going to thank you. They're going to thank you. And they're going to be happy that now you've given them, the opportunity to buy the home that they want, not this limited inventory of properties.
You're solving a problem in the ultimate sense. You're giving them a home that they want, where they want to live. They just can't qualify for either A, the Social Security situation, or B, they don't have the paperwork needed to close on it or whatnot, that a bank wouldn't do it. And you're supplementing that situation.
Yeah. And we let them know, we disclose up front, we're not going to force you to refinance. There's no balloons, but most of our clients are refinancing in about 18 months. If they choose to attempt to do so. And we're okay with that. I tell them all the time, it's like, listen, we know we're not wife material. We're not long-term marriage material. We're like your short-term girlfriend. I mean, we might end up being your one-night stand. I don't care. We know where we're at. I'm not offended. We're giving you what you want, which is we're letting you buy your home. We're getting you in the door. And we fully know that once you're in the door, you're going to try it very hard to improve your situation. And we're totally okay with that.
Are you reporting to credit bureaus? Can I help them out getting a credit? Okay.
Yeah. We're doing third-party note servicing. We're giving them 1098s at the end of the year so they can write off all of the interest that they've paid on their taxes. We're escrowing taxes and insurance. Our paper is beautiful. We're creating QM transactions, QM loans.
For those who don't know, that's qualified mortgages.
Yeah, qualified mortgages. We try to stay under 47% DTI. We're pretty open-minded when it comes to underwriting. How
Just so everyone knows that means debt to income for those who don't know. Sorry.
Yeah, debt to income for sure. So I'm very proud of our paper. If I was in the note buying business, I would buy our paper. It's very, very, very nice.
So how difficult is it to find these borrowers? How much work is it on the upfront to get to hold these people to get your clients?
Great question. So we made a mistake and it took us about a year to realize there was a mistake. And the mistake that we did is we were trying to get to them directly. We were trying to find them directly. And what we found is that the vast majority are terribly unqualified. I mean, for every 1,000 leads that we would get, about 950 were complete junk. And I don't mean that derogatively from the person's perspective, but they had no money, no credit, total lack of preparation. They thought that, we are better than FHA, lower interest rate. I mean, just no common sense as to, who we were. And we corrected that mistake when we came to the realization that the quality owner finance buyers, and for us, quality is those who have at least 20% initial investment and ability to make payments. They might not be educated from a scholarly perspective, because many are not, but they're smart enough to go to real estate agents. So, nugget for all of you guys that want to find the quality owner finance buyers, if that's your audience, go to real estate agents, talk to them. They are the ones that have the contact information. The people who have down payments go to real estate agents. And sadly, real estate agents usually don't know what to do with them. They'll do an MLS search. They'll give them a list of 10, 12 homes in their city that offers seller carry or seller financing or owner financing or whatever it is in your state. And usually these will be, just regular owner finance investors or sellers with the price point of $100 to $175 to $200,000. But when they can come, when that's not the kind of home they're looking for, then we make sure that we're there through social media presence and cold calling. We recently purchased the list of every licensed real estate agent in Texas. They are currently being called and connected with. If anyone wants to know, it's about 160,000 of them in Texas. It wasn't cheap to get, but that's where our quality buyers are at.
It's an interesting play. Nathan, what's your thoughts on that? I mean, because Nathan's bought more of the lease and CFDs than I have. What's your thought of that strategy? What's your thoughts here?
I think that's really good. We were talking just before we got on the call that down payment is key. So when I started doing seller finance way back when, I was doing initially no down payment.
Oh,
that didn't work out well at all. And part of it was because of the kind of houses that we had. Like these were houses that I kind of inherited that were very run down. We had no operating budget to fix anything up, so we were just selling them as is. So because of that, we didn't feel like we could really do a large down payment. But we quickly learned that we needed something. So in those beginning days, I would get, it was just 3 times whatever the monthly payment was. So if it was a $500 monthly payment, then down payment is $1,500. And that was kind of our initial model. And that helped out quite a bit in just, like you say, getting quality people.
Are you still in The quality houses. Are you still in that business model of owner financing, kind of dumperoos?
Occasionally, I don't do a
Okay.
lot of seller finance anymore, but
Mm.
sometimes.
May I share something that has worked with us, because we're still buying,
Yeah, sure.
inventory.
Sure.
When it comes to the dumperoos, what we do is the home is not livable.
Yeah.
We understand that. So we originate basically a non-owner occupied hard money loan for them.
Yeah.
Mm.
So this totally avoids all Dodd-Frank, SAFE Act, rules and
Sure.
regulations. And if anyone has any questions, it's like, well, you can't live in that. Obviously, it's a dump. So what we'll do is we'll do a 3-month loan
Okay.
with almost no money down, but they have to have cash in the bank to fix it up.
Okay.
And basically, it's a very short term, 3-term. If the progress has been made, we'll extend it to 6 months.
Mhm.
We'll extend it to 9 months, and we'll extend it to 12 months. And the goal is very simple. Within 12 months, the home has to be fixed up in an unlivable condition. If they have met those conditions, then we'll do a long-term owner-occupied, fully, Dodd-Frank, SAFE Act, regulatory compliant, long-term mortgage for them. But that prevents us from being locked in long-term
Yeah.
with an unqualified person in a unqualified home. I guess I'll say that in a dump.
Interesting.
Yeah.
So
Well, that's a good
we'll do
idea.
that with ours. Now I heard you do lease options. Is that right?
Yeah. So my lease options, what I do with those is I will pick up a lease option, and because they're not as marketable, I buy to resell. So because
Okay.
they're not as marketable to resell, I will actually convert them over to, depending on the state, land contract, contract for deed, agreement for deed, bond for deed, whatever you're going to call it, depending on where you are.
Bond for deed. I've never heard that.
That's
I only operate in
Louisiana.
Texas. So is it okay?
Yeah. Louisiana and one other state that I don't remember. Anyway,
Learned something new today.
yeah. But yeah, then I'll convert them over, and then when we're writing that paper, whatever, typically they've been in that lease option contract for a year or more, so we'll use whatever they've paid, and I'll be specific. We'll use whatever equity that they've accumulated as their down payment going forward. So that's how it.
So we do lease options as well. I don't like to promote them, but I'll share the way we do lease options. If you have a minimum 10% down, and your DTI is 42% or less, so again, that to me is a somewhat safer position.
Right.
We'll extend a lease option if they believe that they can either qualify for a conventional mortgage within 3 years, or save up the necessary money for the other 10% to close them on a 20% down payment owner finance transaction. Now, this is where for us the cash flow is phenomenal. The monthly payment is based upon what the mortgage payment would be if the interest rate was 12%.
Okay. Yeah.
So, we're making massive cash flow during that time frame. And I tell them, the reason I'm setting it up like this is I want your situation to improve later on. I want this to be the highest payment you're ever going to have to make. And I want there to be an incentive for you to improve your situation, either by raising the necessary capital to close as an owner finance transaction, in which case the payment will drop because we're going to close you right now at 9% instead of 12%. Yeah. Or conventional, in which case it'll really drop, if you get 3%, 4%, 5% interest rate.
Yeah, and same thing. So I'm buying the lease option. It's already an existing lease option, but because they're not very marketable, I can get them at a pretty good discount. Then, like you're saying, it's at like an 11 or 12%. So I'll approach them and say, listen, here's what you're set up at right now. I'll give it to you for 9%. If you can qualify at a bank, you can get 4 or 5% and save a ton of money.
Yeah.
But at the very least, let me save you some money. We'll convert you over to a land contract at these terms, and or contract for deed, whatever. And it's usually a no brainer. They'll go for that in a hot second.
Yeah. Man, I love this.
Yeah.
So when you're working with these borrowers, what is the biggest hurdle that you come across?
From a very early initial qualification? Or
Well, from
hurdle on
either
what
early
perspective?
or along that process of, what are some of the things that either maybe they just don't want the house after a while. What are some of the things that you struggle with that are that hurdles?
Yeah. So the first hurdle, like kind of way before, we still have to go through quite a bit of people to find 20% people. I am totally okay with that hurdle because if I'd rather do, 3, 4, 5 deals a month that I feel very confident will perform than doing 15, 20, 30 that I'm very confident will probably not perform.
Yeah.
So that's a personal preference. There's some people who love volume and love to, just hit that ball, and pray, something will stick. I'm very risk averse. So from that perspective, that's one of our biggest hurdles. We do have to go through a lot of people, even though, we're getting our leads from real estate agents. The second hurdle before the closing is if they're self-employed folks and they know what interest rates with banks are today, the 9% interest rate is a definite, mental hurdle. And again, you got to remember, we're dealing homes in the 300, 350, 400, 450, $500,000 range. So a 9% interest rate is a hefty monthly payment when converted to dollars. And they'll either say, whoa, my payment is going to be $5,000 when I can just rent for $3 in the same neighborhood, which may be true.
Yeah.
Or, and why are you offering 9% when, the banks are right now offering 3%? That usually is overcome simply by talking to them and saying, listen, it doesn't matter if interest rates are 0% right now. If they're not accessible to you, that's just not something you have an option. That's just not within your options. It's like if you're married to a beautiful woman and there are these other beautiful single women, you can't go date them. You should not go date them. I mean, they're not available to you. You're married. That's what's available to you right now.
Yeah.
So, sometimes they get it, sometimes they don't. The other approach that I would say is, listen, how much are you paying right now in rent? Well, $3,000 a month. Great. What's the interest rate on that rent? And that just like throws them off. And like, what do you mean interest rate?
Yeah.
Like, yeah. What's the interest rate on your rent payment? And they, of course, they can't say. And I'm like, look, I want to tell you a secret. It's so high, they can't even legally call it interest rate anymore. They have to give it a totally new name and call it rent. Is the payment ever going to end? No. Is it ever going to go down? No. Congratulations, you're paying 100% interest rate. That's what you're paying. Now, it's so immoral what you're paying right now that legally they can't even call it interest rate. They have to give it a totally new name so that you think of it in a different way. Now, I'm sorry, I can't get you down to 3%. I'm sorry, but I can take you down to 9% from 100%. Can you just be grateful?
Yeah.
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 Oh.
91% reduction.
I'm sorry, I can't do 3%, but I can do 9. Can you just shut up and be grateful?
And you guys typically hold your loans long term.
Yes, I'm not selling any to you. There are none for sale.
And you're typically hold these loans long term. But what is a typical time frame for these buyers or borrowers to get out? Is it 18 months, 2 years, 5 years?
So it depends. We have two kind of pots. About 62, 65, 67% are ITIN buyers. ITIN buyers don't have a social security number in this country. It'll probably be very hard for them to refinance until they reach a 30% equity position, which, I mean, I don't know. Houses are appreciating pretty quickly in Texas now, but it might be 5 years, 6 years, 7 years. I mean, mathematically. The 18-month refinance rate are on our self-employed pool. Basically, whenever they get the 2 years of tax returns, if their credit is where it needs to be, they'll have the equity position, they'll have the 2 years of tax returns, they'll probably have the income, and refinancing is about 18 months.
And they'll have the credit, because if you're reporting to the credit bureaus, it makes it easier.
Yeah, we are reporting to credit bureaus. If they want us, we do have a few, about maybe 2, 3, 4%, where they have great credit, great income, W-2. They could get a bank loan, but for privacy reasons, they come to us.
Wow.
Privacy reasons, they come to us. The largest deal that we've got in our portfolio is $1.2 million. And I am almost 100% certain that the lady that was there with the gentleman was not his wife.
Gotcha.
And there is no evidence that that home belongs to the gentleman.
Interesting.
And I'll keep my mouth shut on that.
It's just business.
Yeah. We had another lady. Her story was that she really wanted to make sure there was privacy. That home didn't appear on her credit, on legal documents, on nothing. Her story was that she was running away from an abusive, boyfriend from South Carolina, North Carolina, somewhere in the Carolinas. And about a year after we closed with her, just one of those things that you're like, let me do a little research on this lady. There was something in the back of my head that just didn't really sit well with me. And I stopped when I got the gut feeling that she may be a fugitive of the law.
Yeah.
And I don't think she was running away from an abusive boyfriend. I think she was the abusive girlfriend. And the boyfriend may be sleeping somewhere 6 feet underground.
Oh dear.
Oh.
Sometimes you just don't ask questions.
Yeah.
And you shared something with offline that was really intriguing because we had just had on Call the Underwriter on and whatnot. You guys go through that process of vetting these people out.
Oh yeah.
And they talked about on our weekly, they vet it out and you can vet out all these people for $200. And if they approve, then you're going to go find the home for them. Versus I have a home, let me bring in these borrowers and let me pre-approve them then, but I'm holding the home and waiting for someone to come to it. You're doing the opposite, complete opposite. You're finding the borrowers, pre-approving who could be approved, who wouldn't be approved by NMLS, and then saying, okay, let's go find the home that you want. I would think that's probably easier than the other way around in some circumstances.
Certainly, in our circumstances, in our business model, it's 100% better because I'm dealing with pretty homes. There is zero holding cost because I've already got a person who liked and approved and is going to close on the home and is going to perform from day one. I'm actually not finding their home. We're not real estate agents. They came from real estate agents, and that's the reason real estate agents love working with us, because once we approve them, very much like a mortgage company, we send them right back to them, and then their work begins. And these are fully commissionable transactions for them. So they do the work of finding the home that suits, the client. All we really care is that it's an appraisable home. So whenever they find it, they submit a contract to purchase. We close 18 days after the option period ends. Which, depending on the option period, it's a total of 25, 28 days. And it's very hands-off, from our perspective. I've got lead generation. I've got pre-qual people where they disclose terms, costs, and conditions in a confidential conversation. Once they like everything that they hear, then we send them to an independent underwriter and third-party residential mortgage loan originator to actually document their real-world ability to repay. Once they give us that information, we give them a pre-approval letter. We send them right back to the agent. They go find a home, and they usually call us, 2, 3, 4 weeks later when they found the home. They have a contract, and we're ready to close on it. So it's very, very hands-off.
So then, earlier you talked about IRA money. How are you approaching your investors? Like, how do you find them first of all, and then how do you pitch them? And I'm not going to ask what you're offering them.
Yeah. No, I mean, I have no problem sharing. We require a minimum 2% spread. So we're offering 7% right now, and we are owner financing at 9%.
Okay.
I have no problem. So if anybody out there, has that IRA money, let me know. I'll tell you what you're going to be getting. If you're getting less, then come talk to me. If you're not, then don't talk to me. It is what it is. So before COVID, something that we did that was really, really smart. I didn't realize it was smart at the time, but now I realize how smart it is we were doing conventions, medical conventions, where we were setting up booths. And that wasn't the smart part. well, I think that was a little bit smart, but the really smart part is we never offered high returns. That was never our pitch. Our pitch was move your money to a stabilized, predictable, reliable, budgetable return. And of course, a mortgage payment is 100% predictable. You know exactly how much you're going to be getting on a monthly basis.
Right.
The underlying asset is insured, and you know, you're working with many of these doctors already had rental properties, so we were moving them from being landlords to lien lords.
Right.
So our pitch from the beginning was not more, because I think that would have gotten us in trouble. Because most people, you know, if they're quasi smart, they're probably getting 6%, 5%, you know, 7%. I mean, 5 to 7% is not unheard of. You know, if you're just like a doctor and a pharmacist, a normal, you know, 9 to 5 individual that has money in their 401k.
Sure.
So if I'm going to be offering more, then what am I going to offer? You know, 8%, 9%. Well, what does that leave me? You know, the only way I could make money was if I pair up the person with the individual buyer. But I don't want to do that because that cuts me from the spread. And I also don't really want to pair up non-educated people with fairly complex, you know, situations. So the really smart pitch that we did is listen, you probably not going to make more. You know, you might make more, but you're probably not going to make more. However, it's going to be a stabilized, predictable, monthly budgetable return. So we started getting people from the late 40s to the early 60s that already had $500,000, $1 million, $2 million in their 401ks, and they wanted to remove themselves from the volatility of the stock market into something that was a little bit more predictable.
So are you guys running a fund, or are you guys running?
No. One person, one loan. We borrow. Yeah, I know I throw the word investor out there, but no, we borrow money.
That's okay.
Sure.
Yeah, we borrow money.
So those
we
who are
personally
wondering-
guarantee it. We personally guarantee it.
Yeah.
You know?
So what they're saying here, guys, they're not joint venturing with any of these people. They're actually doing a return, guaranteed return on a contract with them. So they're actually doing a borrowing versus the equity.
Yes.
There's no
yes,
joint venturing going on at all.
Yes, we don't put the money together. Yeah, that would fall under SEC, you know, bad people, you know, umbrella. And we're not doing that. And my pitch is real simple. Listen, at the end of the day, Mr. You know, lender, Mr. Private lender, you're going to be getting either your money with interest or you're going to be getting a house. Valuable Texas real estate. That's it. We do personally guarantee our loans, and that is part of our pitch. And we're totally okay with that. With a 20% equity position, I mean, that's very reasonable for us to do that.
Yeah.
Oh, good for you. That's
Have you talked to other people doing this in other states? Texas is such a hotbed for this, and in certain states, these kind of going. The CFDs are kind of being pushed out, where this is a little different. This is not a contract deed. This is not a lease option. This is a true seller finance duration, and you're becoming the bank ultimately. You know, for me in New Jersey, this is not something that's very often done. And I think it's, you know, the amount of capital needed, but also there isn't many seller finance deals that is in Texas. It's like we don't do wraps up here, just not allowed. And those kind of things are just weird.
Are they actually illegal? Are they actually not allowed?
From what I've been told, they are.
Okay.
Maybe I would be corrected by one of smart people that I am out there, right? But yeah, from what I was told, because I tried doing one, they're like, oh, you can't do it. And this is about 15 years ago.
Oh, okay.
Oh, okay. So, you know, there's so much leeway in Texas that these kind of things work out really well. I'm sure, Nathan, there's some other states out there that identify Colorado a little bit more, not gonna try to go political, but a little bit more relaxed with stuff. So I think states where there's non-judicial are probably a good area that if you're listening to this, guys, and you're thinking about this, you know, as an method investing, you don't looking to do it. You can start doing your local inventory and reaching out to your agents and solving the problem that they have that they want to get commission off this buyer, but they can't get a loan with them. They can't get a pre-approval, so the agent won't work with them. You're going to go work through it, grab the situation, pre-approve them, get them in a situation where you can be the lender for them. They go back to the agent, and the agent's going to be thanking you and sending you more leads. That process can be repeated over and over again. And I'm thinking
and
about
it could be done. It could be done with contracts for deed as well. If I'm just thinking, for example, maybe in Ohio where, well, if you're going 20% down, then that doesn't work. So scratch Ohio, but let's say there, but say maybe Missouri. You could set up a contract for deed in Missouri. And then in case of a default, it's just that much easier to get the property back. Now you're in Texas, so getting the property back is not a major.
I can foreclose in 41 days.
Yeah.
Yeah, lethal
and it'll
injection is
cost
what we
me
call it.
no.
It's faster than lethal injection, right? It's quick.
Yeah, we can foreclose in 41 days. Not that we would, but if we're talking about, bare minimums, we can foreclose in 41 days.
Just as a backup, you never know.
Yeah.
And I have that conversation, with them. That's actually part of, the pre-closing conversations. I'll let them know that part of the reasons we're comfortable putting the deed in their name is because, if they decide not to hold in their end of the bargain, it will be very easy for us to foreclose. I let them know that, in 41 days, and it'll cost me about $900, I can go ahead and foreclose, and I will exercise my right to foreclose if they are knuckleheads about, holding in their end of the bargain.
Yeah.
So I used to do something real mean or in the beginning. There was a taco place right across the street from where they did the foreclosures and downtown. And I would just invite them over. Hey, I want to get to know you guys before, I lend out all this money. Just have a taco with me, my treat. And they would see all these people. And I would just let them know, if you guys don't ever pay, this is where your house is going to get foreclosed. You see all these people? It happens every month in Texas. It's called Texas Tuesday. First Tuesday of the month.
First Tuesday of the month.
And they're like, oh, wow. Yeah. $100.
Yeah. So for those who are curious, I did put Dan's information on a Google Doc. Just fill out the form and we'll share the information. Again, I can't stress it enough. If you're struggling to find deals, our assets are being a little bit limited compared to years before. Seller finance is a great way to get started and get involved. You don't need to do a $200,000 deal, right? You can qualify someone for a $50,000 mortgage. If your market is top 70, you don't need to go and do that kind of stuff. So you can go look at the fact that talk to those local agents and find the borrowers. It's that easy. And then you're just rewashing it over and over again. And you're solving the problem for both the borrower, then the agent, and yourself. And 9% is not unheard of. That's a normal rate for these kind of high risk loans.
Yeah. No, that's not all right.
Can I share something with the audience if they have maybe a lower capital, or maybe they want to start off with something small? Again, check your state, but this is something that we do. Invest in purchasing small pieces of land, quarter acre, half acre, 1 acre, that allows mobile homes. And instead of owner financing or contracting for deed to the mobile home buyers, just lease them the land. Again, every state is different, every market is different, but in San Antonio and surrounding, I can buy, a half acre outside the city for, $10, $12, $15,000, and I will lease it to them for $500. So if you convert that to what the interest rate would be if it was a mortgage payment on a 30-year amortization, it's about an 18 to 20% interest rate. It's phenomenal returns.
Yeah.
Now, check with your mobile home dealerships, but you don't have to put the utilities. Most mobile home dealerships, when they approve somebody for a mobile home loan and they don't qualify for the land purchase, or they don't have enough money for a land purchase, they will approve them for the home and they will approve them for the utilities. So the dealerships will put utilities and upgrade your land. Now there is a catch, and this is a catch you're going to love. They're going to require a 21-year lease. So can you imagine buying, a $5,000, $10,000, $15,000 little piece of land and having a guaranteed tenant for 21 years? And mind you, you don't have to lock in. the rent payment for the 21 years. It can be fully escalating. As a matter of fact, ours has an escalation clause of minimum 5% per year. So we know it's going to be increasing in the rent payment, a minimum of 5% per year. The dealerships are putting in the utilities into the land, and we know we have a 21-year tenant. The only reason it would be less than 21 years is if they pay it off sooner. So if they pay it off sooner and they want to move the mobile home, they can. But basically, that's an absolute set it and forget it. And you can start off with the small amount of money.
Yep.
Wow.
Very cool.
So if you're in the Midwest or Midwest areas, that's an awesome idea to do, guys. We're saying before, Colorado, in that Midwest strand, Texas, of course, Alabama, Tennessee, is such an awesome market for this kind of thing. And there's so many rural areas that trailer homes are common, and that's a normal thing for a lot of people. Where where we come from, or my area, trailer parks are very rare. They are. But in those areas where rural Ohio, that's true. Rural Ohio's and Colorado and Montana, that is common, right?
Texas.
And Texas. And you can, Kentucky, all these companies, and you can literally buy that land, do a lease option, make a payment arrangement for them, and they will be paying you. They take care of everything else. There is no reliability on you at all. I mean, it's just that kind of weirdness.
There's very little that can go wrong with renting dirt. A few things can go wrong, but very little that can go wrong with renting dirt.
Yeah.
So what happens if the borrower doesn't mow the lawn and the city leans on it? Is that fall on you or fall on that borrower?
So good question. First of all, the zonifications that allow mobile homes are usually not in any city incorporated area. So that's probably not going to happen. Secondly, in the lease agreement, it does say that they have to, uphold and make sure the lawn is mowed and all that good stuff. What is really nice is what happens if they stop making the mortgage payment on the mobile home. So presumably, if they stop making the mortgage payment on the mobile home, presumably they're also going to stop making the rent payment. I mean, I can't imagine they're going to be making the rent payment on the land and not the rent payment. Well, this is where it gets really fun, because you're going to get a call from the lender, and they're going to let you know that they've stopped receiving payments from the borrower. And many times, because banks and lending institutions do not want to deal with a mobile home, they will offer you to pick up the loan subject to the existing financing. So they'll just pass on the loan to you if you wanted it. So there's a lot of people that want to pick up property subject to the existing financing, but they're scared to do on sale clause. Well, with real estate, you got the lenders coming to you and say, hey, do you just want to finish this loan? I'm okay. I will let you do it. I will transfer. I'll do whatever, because otherwise, mobile homes are personal property. And ultimately, they belong to the bank because it's personal property. They don't belong to the borrower until the loan is paid off. So if the lease isn't, and again, this is just in Texas. I don't know other states. Consult your attorney, blah, blah, blah. That's my disclosure. But in Texas, what we can do is if you don't get the lease payment, then the tenant has 30 days to move their crap, which includes their mobile home.
Right.
Now, if they don't move their crap, which includes their mobile home, then you can go to the lender and say, hey, by the way, you're the actual owner of the mobile home. You either have to start paying storage fees, or you got to pay rent, or you got 30 days to move your crap. In which case the conversation usually turns around and says, hey, would you like to just, get this mobile home and continue making payments? I mean, it's a beautiful game. It's a beautiful game with small dollars that a lot of people can start playing with.
Yeah,
Cool.
Awesome strategy. So guys, I did, like I said, post this the form in there, so feel free to fill it out. If you see us later, we'll make sure we'll make it available for those who missed it. Nathan, what do you think about this strategy? It's so cool to think about this alternative method that I didn't even think about for years.
Yeah, that's interesting. I've got actually one lady. It's a lady who she was a land contract in Columbus, Ohio, and she got bought out, which turned out to be a great thing for her. It gave her a nice little nest egg, and house prices are going up in the neighborhood, all that. And so she paid me off and had this money, and she calls me every few months and asks if I have a house for her, and she wants to rent from me or to, you know, buy a house from me. And I'm just not set up that way. You know, that doesn't quite work for me, but she'll contact me every few months.
What state is she in?
She's in Ohio, but she'd be happy to go to North Carolina or stay somewhere in Ohio or Kentucky. She's totally open.
How does she feel about Texas?
It wouldn't be a $300,000 home. It would be, you know, 50.
What's your average home sale?
320.
Okay.
Yeah, we'll do anything from 150. I say 1.2 just because we've done a 1.2, but I think we only have one over $1 million. But we have quite a bit in the $300,000 range, quite a bit.
Cool.
So
and I think, yeah, go ahead.
Sure. Here's a question. What kind of land qualifies to have a mobile home on them, and typically what returns can we expect?
So those are two questions. It has to be zoned for mobile homes. So again, you got to go to your county or to your state. In Texas, it's got to have a zonification of MH, mobile home, or it's got to have a zoning of OCL, outside city limits. So if it's got those two, you know, it'll work. I guess every county or state is probably different on what they do have to allow mobile homes. So it's not like you can put a mobile home in the middle of the city if it's zoned residential.
Any random residential lot.
Yeah. Ask me how I know.
Yeah.
I love it.
Welcome to the wonderful world of making mistakes.
Yeah.
Expensive ones too.
So
and
Leon, Leon, just real quick,
sorry.
You want to know more about how to do these deals in Texas?
That mobile homes?
If you fill out the form, you're going to get Dan's information. Feel free to reach out to him. He has a very, very active social media as well. So feel free to reach out to him. Great guy, as you can tell. Definitely a different avenue to explore on. But yeah, you could definitely do this in Texas as he's doing it. I wouldn't say that he's monopolized the entire state.
Oh no.
So
no.
Reach out to your local agents and start working on it, Leon. But definitely a cool idea for you to get started on this avenue. You know, just connect with it. You can call the underwriter. I'm not sure who Dan uses, but you can call the underwriter and pre-approve these people. Just someone that's NMLS approved that can create these loans and whatnot. So
you want to stay above board when it comes to the originations. You want to stay above board because the penalties are very stiff.
Yeah.
So stiff, you got to go to Canada if you break them.
That's right.
I'm kidding.
It's awesome. So what year did you start doing these kind of things? Did you start unwrapping this idea?
So I think for me, I've always had a creative mind, and I've always had a philosophy of there's probably nothing new under the sun. I mean, as smart as we want to tell ourselves that we are, we're probably not going to be the inventor of anything new. That's just the statistical truth. So for me, it's more like what has already been done, but hasn't been exploited. So what has already been done, but hasn't been exploited. Now, specifically with mobile homes, I did have the advantage of, I used to be manager for Palm Harbor Homes. You know, so one of the things that really had a big impact on me, and I don't know if you guys know this, but about 40% of Warren Buffett's wealth has been made on the backs of the mobile home industry.
Wow.
So he owns, and I love sharing this story, he owns Clayton Homes, which is the #2 dealership in the country. So he owns the factory. He then owns 21st Mortgage, which is the #1 lender of mobile homes in the country. About 80% of all mobile home loans are under 21st Mortgage. So he owns the financing. And then he owns Sun Communities and Guest Communities, which combined are the #1 largest manufactured home park portfolio in the country. They own together about 70% of all of the communities that mobile homes, at least the nicer communities, not the mom and pop, but like the nicer that have like swimming pools and tennis courts and jogging trails and beautiful communities. Mm-hmm. So I'm thinking, okay, this homeboy owns the factory. He owns the financing product. and he owns the land that his homes are going to be put in. Are you kidding me?
Yeah.
So I did the math one time. So a typical mobile home that sells at a mobile home dealership for $80,000, the dealership will buy it from the factory for about $35,000, a little less than half.
Mhm.
Now, in the factory, it costs them about half that to make.
Sure.
So when you're thinking about a cost basis of like 20,000, that you are then financing at 100,000, and you are putting them into your land that you're charging 450, 500, 550 a month
Yeah.
in rent. I mean, those numbers, no wonder he's like the richest guy in the world.
Yeah.
And nobody knows that he's involved in mobile home dealer and mobile home industry.
I don't think I knew at all.
Yeah. So when I was at Palm Harbor Homes and I learned that, I was like, just you don't need to
Yeah.
reinvent the wheel. You just got to figure out where the wheel's at and how the wheel works, and go get yourself a wheel.
Yeah. So
So-
before I go to Nathan real quick, so when they were asking what is the, okay, Sonia wanted to just clarify, what is a typical investment and what kind of returns to buy and lease land for mobile home?
So the return is tied to whether or not you're going to lease option it or owner finance it or lease it. If you're going to be owner financing it, your typical yields are anywhere between 20 to 22%, because you're going to be buying, let's say, at $10,000, $15,000, and the sell price is going to be, $25,000, $30,000, 18% interest rate, because it's land, it's vacant land. You can do that. So your yield is going to be in the 22, 23, 24, 25% range. However, if you're going to be leasing it, your returns are easily in the 30% range, because it's never going to end. I mean, that's really what it comes down to it.
Yeah.
And then, of course, what's the impact on your asset when all of a sudden $20,000 worth of improvements, water, electric, and septic, have been done to your land? I mean, it's just a no-brainer. The numbers are phenomenal. The percentage numbers are phenomenal.
But I would say, I guess the problem is the rarity of finding it, right? The deals are
No.
great. No. Okay.
No. I mean, nobody. How many people do you know are looking? What's your competition?
Yeah, you're right.
I mean,
I don't think we've ever had a mobile home in our portfolio. Nathan, how about yourself?
I have twice, and I'm not interested in mobile homes. And again, that's just my business model, because I'm looking to
Yeah.
resell it. So because I'm looking to resell, because it's not attached.
yeah,
to land, blah, blah,
mobile
blah,
homes is not an asset that works well for any kind of reselling, note
Yeah.
selling,
Yeah.
contract selling situations.
Yeah,
Nobody
so they don't work
understands
for
them.
me. But
Yeah,
I
they're
get
a
it.
great holding model.
Yes.
They're a great
Yeah.
holding model.
Yeah.
Yeah.
So if you're, which is the same as the second.
Yep.
And if you're into the hold, great.
Yeah.
That's
Yeah.
a fantastic model.
Yeah.
Yeah.
That's interesting. I mean, the whole methodology of that kind of stuff is, and there may be a way of playing it, I'm sure there's funds out there doing this kind of method.
Sure.
I don't know
I should
them,
see.
but
Yeah.
I'm at the end of the day, I imagine, once you have a 21-year lease, that's pretty solid paper. You can probably take it to the
Yeah.
bank and recycle your capital, get a loan against it. I mean,
Yeah.
we don't, because we bought them for 10, 12, 15. I mean, it's
Yeah.
not,
Yeah.
Sure.
it's probably more trouble to, get
Yeah.
loans against them.
Yeah.
But
Amazing.
but from a return perspective, it's like,
Yeah. Yeah. I know some
So-
guys that trade in mobile home parks, but not individual.
Yeah.
well, that would
Parks
be
have
the
become
next step
popular.
up. Yeah. Parks would be the next step up. Although, by what I have seen, at least in Texas, there's a lot of capital being infused into it. So I'm starting to see 8% cap rates, 9% cap rates in mobile home parks.
Mhm.
And that's too rich for my blood. I
Sure.
mean,
Yeah.
that does not get me excited
Yeah.
at all. At all.
Yeah. It's amazing. Well, Dan, I think the information you shared for those of people who are looking for an alternative way of investing, maybe even a passive way of investing, but especially those who are getting started, this avenue to even explore. And let's also throw the catch out there. If you find an asset and you get nervous about this, you know, Dan has a course as well, but you can pitch this deal to Dan and say, listen, I don't want to buy it. I did all the homework. Here you go. I don't know what to do. This is yours. You can broker this stuff. Dan, do you buy these kind of things where someone has a great deal and you're scared, nervous?
Only
wanna
3
do
times
it?
a month.
Right? So
Yeah,
guys,
if it's in Texas, for sure. Yeah.
right? So explore that option for people who are out there that, yes, we don't do a lot of brokering. We talk poorly about it. But if you do all the homework and you get everything set up, reach out to Dan or anyone else that does this kind of stuff, and you
Yeah.
can get that sweet situation and get a nice little paycheck out of it too. So
Yeah, I'm a big fan of, Dave, I'm a big fan of learning how to negotiate seller financing. I think that learning how to negotiate seller financing is probably the best way to get your feet into actually owning real estate. And I know you did mention I have a course. For those who are asking, it's like less than $300 and it's 10 hours. So I don't think that this is like a pitch for a $30,000 mentorship or anything like that. It's $300. It's completely, recorded. I've got a Facebook group that people can kind of join and get their questions answered. But what it focuses on is how to negotiate seller finance transactions. And I've got students there that come back to me and they're like, Dan, I pitched it exactly the way you told me. I got it 0 down, 0% interest, 15-year.
that can't be possible.
That can't be possible. And I tell them that can't be possible. How did I miss it?
That's awesome.
So that's super, super exciting.
So I'm going to presume a lot of the people here are brand new. Is this something for an inexperienced investor to get into?
Yeah, absolutely. As a matter of fact, a lot of, and I don't know your audience, but a lot of people start wholesaling. And to me, wholesaling is obviously a high reward, no risk situation, but it doesn't, and I'm sorry if I've offended anybody in this audience, but it does not make you an investor. No. An investor is when your name is on real estate or real assets, whether it's real or paper. When your name is on something, then you've become an investor. Mm-hmm. And seller financing, negotiating seller financing, is an excellent avenue for you to morally, ethically, and legally tell people, I buy real estate. Never mind the fact that it was 0% down, 0% interest. Never mind that. I bought real estate. I own real estate. I'm involved in real estate. I'm a real estate buyer and investor. And I may end up wholesaling your property. But because I now own real estate, I can now confidently say that I am a buyer. I am a buyer. And I think everyone should do that. That's really, you're never going to get out of the transactional one-time money rat race unless you start owning something that pays you on a regular basis. And then once you buy it, you can do whatever you want. You can Airbnb it. You can rent it. You can owner finance it. You can, if you still want to sell the contract, I will buy it. There's a lot of things that you can do with it.
Wow.
Yeah, very cool.
So many nuggets, my man. Dan, I appreciate your wealth of knowledge as well as you share everything. I'm grateful to call you a friend. It's awesome to hear from you. The nuggets you dropped today, I'm sure people will be writing down, re-listening to it. But guys, jump in and get started, right? So it's amazing. But just to let everyone know, the next 2 weeks will be off. Nathan and I will be vacationing with my family in Puerto Rico. So if you're down there, reach out, say hi.
And I don't know how to work Facebook, so there it is.
Yeah, and it's been crazy. Sorry, the feed's been a little crazy. My internet's been wacky today, but guys, I think I brought Dan on for a reason, and I wanted to get this started before I went on vacation. We have a few more things that we're teeing up for when I get back. So feel free to rewatch this on our YouTube channel, our website, our Facebook group, and all the other places we have everything else. But feel free to reach out and talk to Dan directly. He is well open to talk to anyone out there. Has a great group as well. So Dan, again, I appreciate your time, your energy.
Honor's all mine.
You're willing to share. Man, it's awesome.
Yeah, that's great. And
Thank
if
you,
anybody's
thank you.
got anything that they want to talk about, anything they want us to talk
Yes.
about, or explore,
Any
absolutely let
topics
us
you
know.
want us to bring up or bring on, bring in additional guests and whatnot, feel free to let us know, and we'll work our magic and get someone on here and topics we want to learn.
I want to know when real estate will become affordable in Canada.
When it warms up.
Oh.
You know the worst part about Dan? IRAs. They don't have self-directed IRAs up there.
We've got a
my
version of it,
God.
but you can only use it to buy publicly traded something. It has to be publicly traded.
Wow. So if you don't mind asking me real quick, and I know
Yeah.
you got to take off, but Nathan, what do you think? How do people afford, the prices in Canada?
I have no idea. We bought our house 15 years ago for 175,000. Today, we just last year did a major renovation, so that's something. But today, probably 750.
So
It's
is it
ridiculous.
because interest rates are super low? Because I mean that's kind of what's driving prices up here, down here, but what it's
That's
driving
part
them
of it.
up here.
Yeah, that's part of it. I don't know. Canada's kind of a funky little corner, and then it's regional as well. And so like we're right where I'm at, we're just outside of Montreal, and we're just looking this morning, my wife and I just looking at our neighborhood, just comparing. But a 3-in-1 bungalow, just one street over from us. They did a renovation last year where they added on a sunroom, which is really nice. It's pretty, but the house is really nothing special, and it's listed for $600,000. Like it's
Wow.
ridiculous. It's ridiculous.
Yeah.
Hopefully that'll burst soon. And that leads to the question. So Nathan asked the question at the end of every week.
Yeah.
You've got your crystal ball on. What do you see in 6 months to a year?
Bro, I don't know. I'm not smart enough, big enough, knowledgeable enough, deep pocketed enough to know what the markets. I do see that the U.S. in general is in some sort of hyperinflation situation. I was reading that, and it's little things that you don't really catch. Like, for example, there's a guy that he sells street tacos, and we go at least once a week. Real nice guy. San Antonio's a little different, and he was telling me that, like, for example, a box of barbacoa meat, he would buy it for $65 3 months ago. It's $450 right now. A box of bacon was, $85. Everything was under $100, $85, and now it's $380. Cheese, was $110 4 months ago, and it's now $600. And lumber prices are just
Lumber's ridiculous.
skyrocketing.
$3 to $9. Like,
Ridiculous. But even more subtle things like steel, salt, sugar, corn, just very, very subtle but very basic. Flour, staple items are skyrocketing, and the consumer's not feeling it because it's the
Right.
prices. Consumers are buying from the big box grocery stores, and the big box grocery stores, they still have a certain presence where they're able to force, the main, wholesaler distributors to maintain a certain level of pricing. But it's like the small restaurants, the mid, that are really feeling the hit, and eventually it's going to boil over to the grocery stores. But we saw this in Venezuela, we saw this in Mozambique, we saw this and how long is it going to take? I don't know. But things are not going well.
Do you see a bubble? Do you see a bubble?
No, it's not a bubble. It's not a bubble. I don't think it's a bubble in the traditional sense. I think the U.S. and the fiat currency that the U.S. is under is imploding. And I see the collapse of a civilization. Not in 6 months.
Yeah.
Hopefully. But
I gotta get the football season. Come on.
Yeah. But no, I mean we're talking about a global collapse of a civilization. And,
which brings the topic of Bitcoin and all that kind of good stuff comes up. Right?
Yeah.
But you're right though. We've had the conversation with a lot of people, and everyone's like, "Well, even a year ago, we're heading to a bubble. And the bubble keeps getting bigger."
I don't think it's a bubble. Yeah.
It may be the new way of life. It's just what it is.
Yeah. And I did, see, like, for example, hyperinflation in Venezuela. During the final collapse, you could buy bread in the morning and it would be more expensive in the afternoon.
Yeah.
I mean, that kind,
Oh, holy
like the price would increase from the moment you picked it up on the shelf to the moment you went to the cash register to pay.
Hmm.
I mean, it was just ridiculous. I saw it in Mexico, during, the late 1980s. And of course, what happened after that minor mid collapse, the cartel took over, so we'll see what happens. But in the next 6 months, I'm buying deals. So if you got something, I got it. I will buy it.
With that, we're going to disconnect from Facebook, guys. Feel
Yeah.
free to watch on YouTube and all that good stuff. But again, enjoy your weekend and have a great time, my man.
Have a great
Awesome.
one. Been a pleasure.